dynamics and the year of efficiency. Facebook just announced their earnings, and yesterday the stock's up 25%. Part of the reason is that the company is self-proclaimed focusing on efficiency. We had earnings last week from Tesla. We've spoken about this extensively. Tesla is in the business of lowering total cost of ownership, which again is it's all about efficiency. And then we had the FOMC meeting on Wednesday that kind of spoke about the potential now for stopping the whole rate increase cycle. And I think while the pundits are all over the place, from our perspective at Orange Capital Partners, we were always of the opinion that the single most important factor the Fed is looking at is the labor market, in other words, efficiency. Efficiency started to decelerate massively even before COVID, and with COVID it just became basically a huge, excuse my French, shit show. People didn't work, people didn't show up to work, supply chains got disrupted, everything got disrupted. We all know the story. And now this is kind of turning back, turning to the positive. That's why recessions are a good thing, because, or even the fear of recession, it turns people back to what really matters, and that is to have some sort of purposeful job, make money, pay their bills. That's how our society works. We can have a different type of society, we can change our system, but ownership, capital, voluntary exchange, all rely on pricing, on work, on labor, on all of these things. And while that was in jeopardy, I think it's turning back to the good, and that's why the markets are rallying. This is a Not In Wrong podcast. It's February 2nd, 2023. This is Krim Delco. For the day, the fund is up 6.6%. The market's up 1.5%. For the year, we are up 57.2%. The market's up 8.6%. We're outperforming by 49.6%. Now, we had a big rally in the market, like I said. Year to date, we're up 8.6% in the S&P. Risk stocks have outperformed massively. That's why we are in the high 50s already in terms of performance. And there's a couple of other stocks in our fund and then funds that are similar to us that have performed similarly. So this is certainly a macro situation. While we do think that Tesla is a special situation for reasons that we're going to discuss a bit later, we want to focus in the first part of this episode on the macro. And the macro is that the Fed is changing stance. I think it's what was predicted by, to give kudos where kudos belong. Kathy Wood talked about this changing stance. I think we spoke about this independently. And the reason we believe that the Fed will change stance is just because we had deflationary pressures in the economy. And the most deflationary pressure you could think of is the labor market. It's all about the labor market, because the labor market is, people have to go to work to get things done. An economy doesn't function if people don't work. As much as we have AI and energy and even free money and all kinds of things, they're helpful for a functioning economy, but people have to work. Somebody has to actually get it done, deliver the goods, create a software, design something, sell something. All of these things have to be done. And what happened before the pandemic, we had a relatively lax economic environment where, here in Silicon Valley, everybody that knew the difference between C and C++ would get funded for a startup. And we had similar situations in the East where Wall Street was going crazy and advertising was going crazy and all that kinds of stuff. And then we had the pandemic, which made it even worse, because what happened in the pandemic is that all of these things got accelerated because people actually didn't have to go to work, got paid either directly with money or indirectly by not having to pay rent and not having to pay student loans and things like that. So what happened is that a lot of productivity got sucked out of the economy. We had very low productivity, and that increased inflation. And that's why the Fed was forced to move. The Fed is just a bunch of bureaucrats whose job is to maintain price stability, but they also have a job to create jobs, of course. And most of the time, the Fed is obsessed with creating jobs. But every now and then, they have to change stance and fight inflation. And what they really fight is the labor market, at least here in the US. And what they have to do is basically raise rates to make it very unpalatable for people to invest, to grow, to hire people. And with less hiring and all of that, the chances then increase that people start going back to work, that people have expectations of being maybe laid off or at least not paid as much if they don't work and so on and so forth. So that's kind of where we are. And yesterday's FOMC meeting has, I think, cemented the expectation of people like us and others particularly in the innovation investment space, that there will be a change of stance. And as soon as that change of stance happens, the stock market reacts massively, and that's exactly what happened. So we're in tune with the situation, which is a good thing. Doesn't mean it's going to continue without any bumps, but overall we're very much in tune, and that's a very good thing. And for the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So this is very, very important. To be in tune, to be in the same frequency like the market is a very good thing. And that doesn't always happen, but when it happens, then try to stay on that frequency. Try to, this is part of the work we do on a daily basis. And what happened exactly with the Fed is really, words like that they were considering maybe not raising rates, that the disinflation word was used. I don't know if the Fed used it, but definitely the pundits are using it. So a lot of these kinds of things are now swirling around the market. That's why we have this outperformance. And I think what we want to talk about this in this particular episode is we call it the year of efficiency, the 2023 year, the year of efficiency. This is very, very important. If we're right on this one, we're setting ourselves up for a massive, massive outperformance of innovation and growth stocks for the next couple of years. And hopefully that will happen, and we will be able to deliver against our mission to generate wealth by investing in fundamentally new concepts and engineering practice. When you're in the business of innovation, you want efficiency because innovation by itself creates value. So you don't need to have these sort of tailwinds like inflation or a lack of competition or be, all these business terms, pricing power, having a lot of white space, all that kind of stuff is not necessary, because what you're creating as a true innovator, as a true disruptor, technologically enabled disruption is about evolving new niches, large markets that generate lots of customer value. And in those types of environments, all you have to do is execute against your mission, and you will be able to generate wealth. So that's where we stand. We believe that Tesla, with the three big markets they're attacking, which is autonomy, electrification, and energy solutions, has enough room to generate massive amounts of wealth. We don't need any of the economic tailwinds, but of course, we don't want to have headwinds either. And that's what we had in the last couple of probably maybe 2 years. And that's changing now. That's changing, and that's the good news. We are now in a position where efficiency is gaining traction. We actually believe that Elon Musk has been the leader in this. So as a business leader, he is not just a business leader, he's an opinion leader when it comes to CEOs, for example. How do they act? So I think the reaction by Mark Zuckerberg has to have been influenced by Elon Musk's decisions to increase efficiency in his own companies, to lower the cost. Now, of course, Facebook's a very different business, and we don't want to talk too much about Facebook. Quite frankly, we don't know that much, haven't done the amount of research required to really make big picture decisions here. We're not invested, neither long nor short. But what we believe happened with Facebook in the years coming up to, let's say, about 6 months ago when the stock started tanking, is that there has been a lot of slack and fluff in the company, that there has been money printing, sort of, you just make money, no matter what. And then people started drifting away, and Zuckerberg was enamored with this concept of virtual reality. And then the stock started tanking, and that created lots of havoc in the company. What they're doing now is firing people, which is a good thing, because in a tech company like that, you always have slack. So you get rid of that slack. And I think more importantly, also, they're signaling to the market that they're not going to be wasting money on projects like virtual reality. Now, let's just on a tangent discuss this. We at Orange Capital Partners, we're always talking about innovation. We're talking about evolving niches. So why wouldn't we invest in a company like Facebook? Aren't they evolving a niche called virtual reality? Well, the answer is no, they're not. Or at least they're not doing it in the way that we'd like to see it at Orange Capital Partners. That's why we're not invested, because we are not interested in sort of these 0-1 type technologies where you have to spend maybe a decade or more, invest billions of dollars into something that might or might not work out. Now, it might work out, and sometimes that is a great thing. Amazon is maybe some sort of example where that actually worked out, although the jury is open with Amazon because it's not clear to us that there is real value in Amazon other than maybe AWS. But the point is this, like you want to be doing what Tesla is doing. You want to create markets slowly and iteratively. So you want to find something, we spoke about this in the past. You want to electrify the whole transportation market. Well, you don't just work for 20 years and then in one shot, deliver 20 million cars or something like that. That would be crazy. What you're doing is you start with the Roadster, then you launch the Model S, the Model Y, the Model 3, or 3 and Y, and then so on and so forth, semi, Cybertruck. You start evolving your niches, you get fast customer feedback, you start making money, you start generating cash flows, you evolve in China, you evolve in Europe, so you do this organically. The same applies to SpaceX. You want to go to Mars, where you don't just invest billions of dollars and wait 20 or 30 years to go to Mars. You're going to start with the launch business, then you're going to evolve Starlink. Right now, the largest customer of SpaceX actually is Starlink, because Starlink is a real business that actually has traction, that has real cash flow and customer feedback, and all of those kinds of things that come with having being able to deliver customer value. And by delivering customer value, which is the main ingredient, this is the field. Validation is the oxygen of entrepreneurs. I think in our essay recently, we wrote an essay about this. The anatomy of disruption, and we spoke about this at length. I'm going to put a link in the show notes to that. What I'm trying to say here is that the reason we're not so excited about Facebook is because we don't see that sort of feedback loop, and maybe that's what Mark Zuckerberg is trying to do here. We're not sure, but fundamentally what he's doing, and this is now the sort of the meat of our episode, it is really about efficiency. It's about getting rid of the slack, getting rid of the fat, getting rid of the fluff. Tighten your belt, work, you can do more with less. This mentality, which is now spreading across Silicon Valley here, and then hopefully across the country, is going to help the Fed with their stance of not keep raising rates, and then hopefully keep price stability. There is a possibility of a Goldilocks outcome here, where we have efficiency and growth and real growth and innovative growth, which creates good deflation a la Tesla, where we create more customer value, which is driven by the lower cost of lower total cost of ownership, which in itself is a good thing. And then that creates deflation. It's just good deflation is just more flexibility for customers to do more things with their money. So, I guess to summarize, what we're saying here is that there's a very good sort of momentum now in the economy, because we have had this big period of fluff and fat accumulation in the economy. The Fed has done the right thing by raising rates. Now, the Fed in itself, in our view, has made mistakes. They shouldn't have underwritten the disastrous pandemic policies, in particular the spending of trillions of dollars to support this COVID hysteria. But they did. But nevertheless, you can make mistakes. What's important is that you don't keep doing them and that you start correcting them. That's what the Fed did. The changing of the stance, which I think was sort of accentuated yesterday in the first phase, is a good thing. But we need to follow up now. The economy has to follow up, and most importantly, also the politics has to follow up. Obviously, the federally financed pandemic relief funds have to be cut now. There's no way that people can still, let's say, not pay rent or get paid for not working because of some sort of COVID risk. That has to go away. People that are at risk with their health, they have to rely on the existing institutions of healthcare and so on and so forth. We can't have this pandemic measures anymore because it's just too expensive and they damage everybody else's well-being. So that's what's called inflation. So we're returning to a more normal stance, and the Fed is able to return to a less aggressive stance. And these are good things, particularly for growth stocks and particularly for companies that are putting efficiency. Number one, efficiency means a lot of things to a lot of people. For us, it means lowering the total cost of ownership and increasing customer value at the same time. And this is what what ultimately will generate wealth. And this is what matters for us investors. Thank you.